Principle of Macroeconomics, Chapter 16, Exchange Rates and International Capital Flows. Professor Wagner. In this chapter, we're going to talk about foreign exchange markets, demand supply shift in foreign exchange markets, macroeconomic economic effects of exchange rates, and policies. Is a trade deficit between the U.S. and European Union good or bad for the U.S. economy? That is something that could be argued either way. How does a foreign exchange market work? Well, there's something called the Forex, which is not mentioned in this thing. And basically what it does is it collects $1,000,000 rates on all currencies, and they'll compare them to the US dollar or to each other. And there's an actual market where people will trade currencies because their value fluctuates with the changes in the various countries' economies. So a country that is not the United States that uses the dollar as its currency. Panama is such a place. They use the US dollar as currency there. Many South American countries will use a shadow economy or a parallel economy that's run on dollars as opposed to the local currency because of volatility. Also, the foreign exchange market, once again, go back to Forex, and the exchange rate is basically however many dollars a euro can buy or vice versa. And it's the largest market in the world economy. About a little over 5 trillion per day is traded. In 2013, that's their number. The real GDP in the same year was nearly 16 trillion per year. There are 4 groups of people or firms who participate in these exchange markets. Firms that are involved in international trade, tourists visiting other countries, international investors buying ownership of a foreign firm, or international investors making financial investments that do not involve ownerships. Firms that buy and sell on international markets. There will be costs for workers, suppliers, investors, measured in the currency of the nation where it's produced, and also revenues will also be measured in the same currency. Financial investments that cross international boundaries require an exchanging policy. A foreign direct investment, an FDI, purchasing firm, at least 10% are starting up a new enterprise in another country. Portfolio investment is purely financial, doesn't involve any management responsibility. And then there's a hedge, using financial transaction to protect against risk. So guaranteeing a certain exchange rate in the future. That's done with Forex futures. And just like pork bellies and orange juice, that's traded on the Chicago Commodity Exchange. Like futures, puts and calls, they're also available for the money futures market. And so a portfolio investor trying to benefit from exchange rate movements. And so they give you a couple illustrations here. They'll take a British pound worth $1.60, and that's kind of wishful thinking. It's more like about $1.25 right now. Instead of its current rate of $1.50, may hope for following events to change in turn. So they'll buy the English pound and they'll wait for the exchange rate to change into the positive territory, and they'll cash out and they'll earn a profit. And then there's other expects in the future that, likewise they can go short. The first position was kind of a long play. A short play means that they're kind of betting that the currency is going to go ahead and devalue, so that they would be able to make a short play against that currency. Foreign exchange dealers, there are a great number of them, roughly about 2,000 firms. We have less than 100 foreign exchange dealers, many of them people who have foreign banks domiciled here in the United States. Deutsche Bank is a really good example, and BVBA, which is Compass Bank, is a Spanish bank. They do something similar. You have most transaction markets are for portfolio investment, And then the foreign exchange market involves firms, households, investors who demand supply currencies. Basically, it's the meeting point, so where they can trade based on market movement. As part of monetary policy and trying to create, some type of effect where, a country may decide to have a little bit more swag, in terms of the power of the currency. So they may decide to, appreciate or strengthen the currency. So you reduce the money supply, and so the currency is worth more in terms of other currencies. So if you were to go ahead and say do a lot of importing and you having a strong dollar will get you in a position that we'll be able to buy more. In terms of exporting, you probably want a weaker dollar because then your goods cost less to countries who can buy or use more of that currency available to them. So those are a couple of examples of why. And so you have an illustration of appreciate versus weaken or depreciate. And basically we're looking at the Canadian dollar versus the dollar in the top graph. And then we're looking at the other, the flip of the graph where we look at US dollars per one Canadian dollar. Here's a little chart that you might find useful. So, if you were like I said, if you're exporting, stronger US dollar, not good, weaker, better. And so you can kind of take a look at this as kind of a Boolean truth table of sorts that will tell you, what position is better in terms of appreciation or depreciation of local currency, in our case, the dollar. Demand and supply shifts in foreign exchange markets. One reason to demand a currency on the foreign exchange market is the belief the currency value is about ready to increase. A reason to supply a currency is that there's an expectation that the currency will decline. Here's a couple charts that speak to the exchange rate for dollars and pesos. And so the quantity of US dollars traded for pesos and pesos per dollar. So there's an equilibrium point where the quantity of US dollars traded for peso is about 8.5. Yeah, and then there's 10 pesos per dollar. If you flip it, so you have dollars per peso. In this case, you have quantity of pesos traded for US dollars. The equilibrium point is for every dollar, for every dollar per peso. And you can notice these are decimal points. The equilibrium point is at 0.1 and about 85. Here you have, once again, a look at both exchanges, pesos per dollar or dollars per peso. They both have a supply and demand curve where they intersect. And so there's an equilibrium for each of these curves. And this is a graph that speaks to Mexican peso reacts to expectation about future rates. So basically, it's about whether the expectation is that the either currency will become weaker or either currency will become more expensive or more buying power. And so it'll make basically there are 3 points being made. And so an announcement that the peso exchange rate is likely to strengthen in the future will actually create the demand for pesos. Similarly, it'll take investors less likely to supply pesos to the foreign exchange market because they're now somehow more valuable. And then the shift to the demand to the right and the supply curve to the left will cause an immediate appreciation in the exchange rate. And you can follow this on Forex and you'll see what's going on. It's actually something that's happened constantly in perpetuity across the globe, and you can follow it 24/7. Differences across country and rates of return. Motivation for investment, whether it's domestic or foreign, is to earn a return. Return rate in the country looks relatively high. That tendency in that country will attract funds from abroad, meaning that they will either get a higher interest rate on money saved at the banks, or if they supply capital to companies in that country, that they'll get an extra amount of percentage return for that. Conversely, if a return in a country looks low, money goes where it's treated best. It will flee to another economy where the action is simply more exciting to play, and so there'll be an exodus of cash. Changes in the expected rate of return will shift demand and supply for currency. Exchange rate, market for US dollars reacts to higher interest rates. So once again, monetary policy will impact dollars. So a higher rate of return for US dollars will make them more attractive. Thus, the demand for dollars in the foreign exchange market will shift from D0 to D1, which would be to the right, while the supply shifts from S0 to S1. So you come up with a new equilibrium point from E0, and that moves up to E1. Relative inflation. If a country experiences a relatively high inflation rate compared with other economies, then the buying power of that currency is eroding. So it's just less potent in the marketplace and less desirable to own, unless there's somehow a bet on the side saying that the country's economy may get, some kind of shot in the arm to turn around the strength of the economy, therefore the currency. Also tend to discourage anyone from wanting to acquire or hold the currency, because it could simply be devalued to nothing. This has happened a few times in history. The German mark during the Weimar Republic is such a case. Brazil's had this happen to them a couple of times. Several South American countries have also had a situation where the currency was near valueless. Argentina is famous for this. Exchange rate markets react to a higher inflation. So if a currency is experiencing high inflation, its buying power is decreasing, and so once again, they don't really want to hold it, people. And if a rise in inflation in the Mexican peso would lead a demand shift from D0 to D1, supply will increase from S0 to S1. Both movements in demand and supply will cause it to depreciate. And so we have two situations here where we can, shift it. We can shift the demand curve over here to the left, and then against the original supply curve, there will be an equilibrium here. However, this is an equilibrium point, and this is a new equilibrium point as well. Arbitrage is a process of buying goods and selling goods across borders to take advantage of international price differences. Basically, it's like day trading, and you're just moving money back and forth. You're taking very thin slices of profit margins, and you're chucking them to the side in the bank. And so this is a common practice. I've done this, and it was pretty advantageous. Then you have a purchasing power parity. So there's an exchange rate that will equalize the prices of internationally traded goods across countries. And it has two functions. One for a comparison of GDP and other statistics, and also exchange rates often get closer to it as time passes. Macroeconomic effects of exchange rates. A central bank will be concerned about the exchange rate because movements in the rate will affect the quality of the aggregate demand in an economy, and frequent substantial fluctuations in the exchange rate can disrupt international trade and cause problems in a nation's banking system. I'll go back to my Argentina example. They actually have a discount rate, like our Fed discount rate is like probably 0 right now. In Argentina, that number is somewhere between 33 to 50%. So there you can see the extremity of the differences. And so the Argentinian currency is, it's of questionable value. And for those that trade in that country, there's a shadow economy based on the US dollar that operates within the borders. So people making substantial trades of goods or services are probably operating on that marketplace. And so there, fluctuation in exchange rates. There's really, one of the most economically destructive effect of it rate change fluctuation that can happen through the bank system. Banks would not be able to repay their loans. The Weimar Republic, Germany idea was to hyperinflate the currency and make it pretty much valueless and pay the French back the billions of marks in reparations that they owed after World War I, and they paid it with basically worthless currency as a way to duck out of a harsh peace treaty being imposed on them after the First World War. Banking and international borrowing. So banks will borrow $1 million and agree to pay a 5% interest. So this is basically a chart. And so this is a scenario of borrowing that ends on the left is a successful story, but the right one on the right shows what happens when the exchange rate weakens. So it's comparative. You might want to take a look at this chart, understand it for the test. And so exchange rate policies. And so these are concepts a nation may adopt one of several variety of exchange regimes. You got a floating rate, you got a soft rate peg, hard exchange pegs, and emerging currencies. And some countries actually will use the US dollar as their reserve currency to prop up their own local currency. Rates. The US dollar as a floating exchange rate are one of the world's currencies of about 40% of the world's economy. Major concern is that exchange rates can move a great deal in a short period of time, but the reason that 40% of the world is based on the US dollar is the idea that the US is able to make good on its debt. The US dollar as opposed to the Japanese yen. And so you have kind of a long history from the beginning of the year 2000 up till July of 2015. And you can see how it's fluctuated, where a real high was achieved in 2002, and a real low point, probably a time to buy yen or buy dollars with yen is right here at 2012. So you can see the variation in the curve. A couple more definitions: soft and hard pegs. And so basically, soft peg says that it allow the market to set the exchange rate, but they'll have some type of let's say slop factor, or has some ability to move, and if it seems to be moving rapidly in one direction, the central bank will intervene in that situation. And then the hard peg is where bank sets a fixed and unchanging value for the exchange rate. So basically, let's say $1 US for 1.5 Canadian dollars, and that's kind of set in stone. That's not what's actually happening, but that would be an example. So here you have a couple of exchange graphs. We have reals traded for dollars, and so if an exchange is pegged below 30 cents per real, what would happen to otherwise be the equilibrium? The quantity demanded will exceed the quantity supplied, so there'll be a shortage. People want it here, however, what's being supplied is here, and so this gap would be the shortage. Here, if it's on the flip side, if the line is above the equilibrium point, then this would be quantity demanded would exceed, it's not as high as what's actually being supplied, certainly at that rate. Merge currency, when a nation chooses to use another nation's currency. Panama's done this. Actually, Panama's done this for a long time. We've had a military footprint in Panama. We had built the Panama Canal in 1903, one of the, I'll just say one of the architectural wonders of the world for shipping. And so, with the amount of influence and with the generally perceived stability of the US dollar, Panama just has simply decided that there's no need to have a separate currency. A dollar works just fine there. And then there's Tobin taxes, controlling the flow of capital, so international capital flows is the flow that crosses national boundaries, either portfolio investment or direct. Tobin taxes are on international capital flows, and the policy is to reduce international capital flow and reduce the chance of large movement in exchange rates. Practical difficulty because national governments impose taxes and not international ones. That's not come about, not likely to. This concludes Chapter 16.